So the big tax question is this: how do wealthy people keep their money working for them when selling their business, real estate, or other highly appreciated assets without paying hundreds of thousands to millions of dollars in tax? What if we, as business and real estate owners who have poured blood, sweat, and tears to growing our wealth, and who didn't hire expensive tax attorneys and CPAs to map out an exit strategy, knew their secrets? Instead of recreating the wheel, why can't we just model the way they deferred 30 to 50% in tax, paid off debt, funded their next business dream, and most importantly, leave a financial legacy to give to the causes we believe in most? What if their secrets weren't complicated at all, and you just need a guide who is a few steps ahead of you? That is the question, and this podcast will give you the answers. My name is Brett Swarts, and welcome to Capital Gains Tax Solutions. Welcome to the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is the best way for you to exit your highly appreciated cryptocurrency, real estate, business, or other highly appreciated assets. I'm your host, Brett Swarts. In each episode, I'm joined by some of the best financial, wealth, business, and entrepreneurial minds in the world, where they share their ideas, deal stories, and inspiration. So together we can make complex tax deferral strategies simple and passive income plans achievable. I'm excited about our next guest. He is one of the co-creators of the Wealth with No Regrets planning process that allows a process that shows financially successful professionals, executives, business owners, and independent women how to live more confidently by having a custom-tailored financial plan, income plan, tax plan, legacy plan, and legal plan. He, as a registered investment advisor of Boomfish Wealth Group, LLC, where he's a co-founder since 2010. They act in the best interest of their clients. He acts as one of the best interests of their clients as a fiduciary for his clients. Please welcome to the show with me, Barry Spencer. Barry, how are you doing today?
Great, Brett. Good to be with you. Thanks for having me on.
Yeah, absolutely. And for our listeners getting to know you for the first time, would you give us a little bit more about your story and your current focus?
Yeah, absolutely. So the story of how I got into the business and why I'm doing what I do. Is that what you want, Brett?
That sounds great.
Yeah. So I don't know. Maybe other people can relate to me in this way, Brett. I was entering into middle school, and if I go way back, I was entering into middle school. I was the new kid on the block. I had gone to a different school, so I didn't know anyone going into sixth grade. And my parents thought that was a really good idea. In hindsight, not really. And I was also smaller than the other kids. I now stand 6'1" tall, but back then I was really small. I was what you call a late bloomer. And so as a result of that, I got picked on and pushed around a lot, which is not a great experience. So when what I didn't realize until later in my life, what was growing in my heart was a desire to help people who were getting picked on and pushed around. You know, people who didn't have options and no one helped them with them. And so fast forward into my adult life, and my dad was losing his battle with cancer. He's losing his battle with cancer. He's done all he's supposed to do financially. He's been an entrepreneur, business owner, very successful financially, great family. And then, did what most people do, reach out to friends of his that were in the brokerage business, and turn over, their money to these different brokerage folks. And then he was supposed to be all set, right? Well, no one helped him with a financial plan for he and my mom, should they have a long life together or if she was on her own. And no one helped him with a tax plan either. And my dad was also really generous, so no one helped him with a charitable plan. And after my dad passed away, I woke up executor and trustee of his estate. And I thought, oh, this is why. And I was thinking back to a conversation he and my dad, I had with my dad, and he said, Barry, you're going to need to take care of mom. I thought, well, why would he say that? Why would he feel the need to say that? I thought he had done everything, right? He had a will. He had his, friends that were in the brokerage business. And I thought, why do you need to say that? Well, come to find out very quickly that there were a lot of things that weren't handled, that weren't considered, from taxes to charitable planning to income planning to exit strategies in the, his real estate, his business and the like. It was a convoluted mess. Because the only thing the brokerage people really care about is assets under management, right? If I can just assets under management and make you feel good about the return I'm giving you each year, then that's fine, But for those that have, more than, $500,000, there's a lot more you can usually do and a lot more you really need to do. And that took me a few years to figure out, share that story with some folks, and people wanted to start hiring myself and my partner. My partner's the CPA. He's the numbers guy, and he's a former auditor. So we have audited plans and then act in a best interest of our clients, doing a lot of planning, tax planning, and the like. So, that's what really drove us in, because we felt other people had the same experience we do, and they didn't have many options and didn't know who to look to.
Beautiful, Barry. Amazing. I love the desire to help others who perhaps either don't know or might be taken advantage of, and not having a tax plan or a charitable plan or financial legacy passing plan. So yes, we're gonna have fun talking about all of that. By the way, Wealth with No Regrets with co-creator Barry Spencer. So you can find Barry Spencer at wealthwithnoregrets.com. That's wealthwithnoregrets.com. Barry, before we dive into some of these secrets and some of these things that you help your clients with, I want to take one other step back. I want to go back to the high school days, maybe the college days, right? I believe we've all been given certain gifts in this life, and these gifts have been given to us to be a blessing and help to others. Some people call them superpowers. I think they're God-given abilities and gifts. So I'm curious, what are those one or two gifts that you believe you were given, and how does that help how you help and bless people today?
Yeah, I love how you say that, by the way, because we've all been given talents or gifts. The Bible talks about talents, and we talk about gifts all the time. And it is right. It's not for us. It's for the benefit of others. So for me, I think what grew in my heart was to look out for people. And a way that I do that, I think the unique gift it is from 2 points of perspective. Number one is just leadership, because I believe what's really missing in the industry is helping people get clear about what they want and where they are now. And that's really a leadership thing, whether you're in the financial industry, whether you're running a business or what have you. Vision drives everything. And so that vision and getting clarity about vision, about the future and what you want, I think is number one. And then secondly is to think strategically. So those are the second gift, really, I feel like God's given me. And that is to think strategically, about how these things work, how they fit together, why they matter for you, and how they kind of interact and interrelate, and how it puts you in a better spot, whatever that is. And so those two things, I think, is where I've spent most of my time, and also where it's ended up being beneficial for clients. And I think also being smart enough to know I don't know everything, and I can't be an expert in everything. And so that's where my business partner, Scott Noble, comes in, because he's super smart, super savvy, auditor, CPA, CFO. So when it comes to like running the numbers and making sure they work, he's just really super fantastic at that. So I just let him handle all of that stuff, and we work really well together. So I guess if you have superpowers, know the ones you don't have and partner with those that have the other ones.
Very well said. Absolutely love it. So now let's dive right into and we'll focus on tax this time, a tax plan, right? So Capital Gains Tax Solutions is the podcast, is the company.
Yeah.
So what's the number one best secret that you found for helping your clients create a rock solid tax plan?
Well, I wish there was only one thing, but we can focus on one thing here. And I think the first thing is to recognize that you have a tax problem potentially. And so the first would be focus on the fact that there might be some tax opportunities and solutions, and look at your assets. So one of the things that we come in contact with all the time is precisely for your show in particular, is people with a low basis in a highly appreciated asset, whether it's real estate or some type of stock or equity. We find it's often a concentrated position in a large publicly traded stock, or real estate that people have worked for a really long time. So either way, there's a low cost, low basis, high gain. And where we find the sweet spot really is someone who is also charitably inclined, because whether people realize it or not, you're charitably inclined. That's what taxes are. It's your social good back. You get to either choose how you get to do that or you don't. And so for us, that sweet spot is you find that high gain, and then you find the charitable intent, and you put those two together. And so we use essentially capital gain. We call it a capital gains avoidance strategy. And essentially, you avoid the capital gain and the sale up front, but you also fulfill some visionary ideas at the same time from a giving standpoint. And it can be a real lever. It can be a real leverage point, if you will, for people to be able to accomplish the tax saving as well as, income, as well as the charitable giving piece. So it's a multi-tier ability for them to do that. Of course, you can make them work even if people aren't very charitable inclined, as you know, right? I mean, as you know, there's many different ways to do that, but that's where we've seen a magical connection and a big lever for folks.
Excellent. And so what you're referring to is maybe the Charitable Remainder Trust. Is that what you use, Barry?
So I always withhold the name until I help explain what it is. Because if you can take an asset, you can sell the asset, you can avoid the capital gain in the sale of the asset, you can diversify that asset, convert it into income stream, and then you can also create charitable gift and get a tax deduction all in the same transaction with the same asset and the same vehicle. Is that appealing? Yes, it happens to be a charitable trust. It can be a charitable remainder trust, charitable annuity trust, charitable unit trust, charitable remainder unit trust. There's lots of different variations of that, as I'm sure you're aware, Brett. But the idea I love to get people connected to is the ability to do those things. And if you can do that, then let's talk about we can call it by its technical name. A lot of people get confused by the technical names, I find.
Yeah, no, that's great. And you're absolutely right. And it's a nuance there, right? And there might be some, a little bit variation of one you might use, but very good. All right. So the biggest tax problem or biggest secret to helping have a tax plan is recognize you have a tax problem, right? And guess what? Your biggest expense in your life is taxes, right?
That's time.
With everybody, right? And so
Big
tax
time.
problem. So recognize that.
And it's getting worse, Brett. And people don't even realize it.
Yeah, Mr. Biden is in the administration is proposing some really kind of I think punitive, 20 to 40% on the federal, 39.6 on the capital gains tax rate, right, which is huge. I'm in California. We're just touring a winery house, and it was an $18 million sale. They have a $10 million gain, and they bought it for $8 million. They're selling it for $18 million. They're looking at a $10 million gain. So that's 33% in California. As a primary, that's $3.3 million. Well, if the 20 gets at it, that's another $2 million, right? So it's pretty incredible what's happening right now, as well as potentially taking away or limiting the 1031 exchange, right? Which is another thing that a lot of folks like to use for investment real estate trading, right? To defer the tax. But before we go too much back into that, on the CRTs, I'm curious, what's the biggest objection to any of the charitable tax deferral strategies that you've used, that you found, Barry?
The biggest objection that the client has to those, I think, is understanding for them how much they use during lifetime and how much is a remainder amount to the charity at the end. And I think that's a delicate balance between how much deduction do I want to get now, right? Because not only do I avoid the capital gain in the sale of the asset, but I also get a tax deduction. Well, that tax deduction is interwoven with the income stream you're going to take off the asset. That's the connection point. So there's a lot of math calculations that we go through with folks between how much deduction do you want and need, and how much income stream do you want to pull off it at the same time. So I'll give you, for example, like if someone is really interested in the deduction, right, because that's their biggest bogey is the deduction, then we're gonna reduce the cash flow coming off of the trust to amp up the deduction part, because maybe they have a whole lot of other income over here somewhere, and if they have a whole lot of income over here, they're better off to offset that. Does that make sense? So the bigger deduction matters to them, and they can let the remainder asset value be the charitable giving piece down the road that they want to do anyway. If someone's not as interested in that, they say, well, we're really doing it for cash flow, then we minimize the deduction because they're avoiding the capital gain in the sale anyway. So we minimize the deductible part and increase the cash flow part. So they're avoiding the gain, which is what they really want to do anyway. And then we're just really driving down the value of it through the means of the trust by having increased cash flow and minimizing the deduction.
Excellent. Yeah. So the key is obviously customized to the individual, right? And if I'm hearing you correctly, you're saying, how much will you use in your lifetime, right? And really understanding that, what are you going to spend? What are you going to invest? What do you want to do with it? Versus giving it to the charity at the end, right? If I'm hearing you right. And then either way, you're going to be, in your words, avoiding capital gains tax, right? And you're going to either say heavier deduction up front, right? Or set it up in a way where you're getting a heavier deduction out or heavier cash flow. And then based upon those two things, that's how you would design. Is that a fair summary, Barry?
That is about the strategy itself. I think if you come back out strategically and look big picture, it's very, very important to not design these in a vacuum. You've got to come out big picture and say, what are all the other assets you have? What is all the other income you have? How is that going to play out over the next 20 years? And what are the other dangers you're trying to deal with at the same time? And so, if someone has a whole lot of income over here, then we're really trying to go after a deduction so we can offset that. So you actually have more income, not specifically from this strategy, but from the other money at the same time. So I find the danger all the time that I see, and the attorneys do it like crazy, that I have seen over and over again, which is why we do all this. And we are not attorneys. So I am not giving legal advice, and I'm not giving any tax advice. But what I'm saying is they get stuck in the strategy, and they get stuck in calling it a charitable remainder trust and talking about how it works. And people get too focused on the thing instead of looking at how it interacts and how it interplays with the overall picture. And that, to me, is where people get over the hurdle of understanding what's in it for them. Is when you see it within the big picture. Does that make sense?
Makes perfect sense. So let's talk about those other things, right? One of them, which is one of the bigger ones, is the estate tax. So many people get so caught up in the capital gains tax deferral or avoidance with the CRT and the stepped up basis, which, by the way, Biden is considering taking that away as well.
Can you
which
believe
is just
that?
Kind of mind-blowing.
It's
We'll see if
mind-blowing.
it passes. It's still just a proposal, but it's literally taking the wealth from baby boomers, which, by the way, it's the largest wealth transfer in the history of the planet. And what's happening is they want to take that wealth, if it goes, what they're saying on paper and with the math is they want to give it all to the government, right? That's basically what they're proposing here, which is pretty daunting to think about. I did a study for a client, a $100 million client, and we're looking at all of it inside of his taxable estate and what would happen upon passing. Not only would the kids not get the stepped up basis, but then you'd have the 40% estate tax, right? So this is the part where you're going to look at how are this strategy of what you're doing interacting with the estate tax. So let's dive into that right now, Barry. How are you helping your clients when it comes to the estate tax, and or how are the variations of the CRT helping to move that outside of the taxable estate?
Yeah, well, first of all, the CRT can move it outside the estate. So it is outside your taxable estate for estate tax purposes. And we always call it the potential double tax, because you can also use it with a retirement account. You can use a charitable remainder trust with a retirement account, and you can, upon death, and then you can also get you can put back into place the stretch provision that was taken away with the Secure Act. But you're also, by creating the charitable remainder trust, you're also getting creditor protection. So you're getting creditor protection. You're moving the asset outside of the estate, and for estate tax purposes, then the next thing would be, well, wait a minute. If I move the asset outside the estate for estate tax purposes and I put it out there, and the remainder benefit is the charity, then the grantor or trust creator, the wealth creator, says, but I want my kids to get it. So that's where I want my kids to get money, right? So then you look at the total situation and say, what other assets are there that they could get? Will they get a stepped up in basis, and are those protected or not? So then the idea then goes down the road of this and say, well, if that's the case, why don't we create more wealth outside of the estate? So when you pair up the charitable remainder trust and you pair it with another trust outside of the estate and you fund it with other assets outside the estate, now you have an asset outside the estate that the charity is going to get, but you're going to get the benefit of during lifetime. And then you create another asset outside the estate that is estate and income tax free that now the kids can get. And it becomes a lever, which then you take the assets left in the estate and you say to the parents, the wealth creators, and say, so spend those down as much and as fast as you can, because you've already set up a charitable legacy. You've already set up a family legacy. So now you can just not worry about what you spend. Give to the kids, take them on trips. I mean, do all those other things that should be a part of their goals anyway, and do those during lifetime and not worry about a remainder benefit because you've already secured those in a tax efficient way, estate and income tax purpose, which I think is coming back into play. I know you mentioned $18 million deal and $100 million deal, but this is coming into play for even people, say with 3 million plus, to be honest with you. That is what this administration is bringing back into play.
Absolutely. And just to and clarify what Barry's referring to, that right now the exemptions are 22 million, 12 million single, right? For, let's say you're worth $52 million, and we'll go back down to the 3 million. And all 22 is in, and you're married, and all 52 is inside your taxable estate. Well, that leaves 30 million that's subject to the 40% death or estate tax, which is $12 million. Now, those limits are set to expire in 2025. However, Biden administration is even talking about potentially proposing going even lower than the expiration. The expiration is set to go 12 million married, 6 million single. He's talking about even 7 million married, 3.5 million single. So this is literally a lot of wealth that if it's growing today, where is it going to be? Which is part of the modeling you want to be doing as a high net worth individual or as a business professional, helping your clients model and cash flow this out. Say, okay, what's your net worth today? What's your life expectancy? What potentially could that grow with over the next 5, 10, 15, 20 years? And what does that mean for your estate tax? It's no longer a cash flow type of equation. It's a tax flow type of equation. And we want to know where and how are these taxes, because the game has shifted to that, and you want to have solutions for your clients. And which leads me into the next part of this thing, Barry. So we specialize in a thing called a Deferred Sales Trust here. Mm-hmm. It's kind of like a CRT, except no C is required.
Right.
But what's unique about it is it can also move funds outside the taxable estate. It works for public, private stock, cryptocurrency, real estate. You can save a failed 1031 exchange. It's based upon IRC 453.
Yep.
And it's kind of nuanced. It's kind of new. In fact, I saw that we had a common, friend, if you will, probably better friend for you than is me so far. But his name is Kevin Harrington. He came on my show, and he goes, Brett, I bought a stock at 26 cents, or I got some shares based upon ownership, and now the thing's worth over $20 a share. He goes, are you telling me that you can defer capital gains tax on the sale of highly appreciated public stock? And the answer is yes, with the Deferred Sales Trust. And I'm just curious, have you heard about it before? It's, by the way, it's not a Delaware Statutory Trust. It's not a 1031.
Right.
Have you heard about it before? I'm curious what your thoughts are on that.
Yeah, I think it's a great idea. I've heard of it before. I've seen it in use. I haven't personally used it, but I have seen it before, and it's a great strategy, especially if people aren't very charitably inclined. We've gravitated towards that ours so that we can get the deduction plus the deferral and the avoidance of it. But for those that are not, by the way, Kevin has told me that story because we worked on a book together called Build Wealth Like a Shark. And so that just came out this year. So we worked on that book together. And Kevin shared that exact story with me, and I think it's funny. He's always on the prowl. He's just a great guy.
I think he's still looking at it. And Kev, if you're hearing the show, come on. The attorneys are ready. The CPAs are ready. Let's get Barry in the room to ask some tough questions with us, and let's figure this thing out that works. Yeah, we do no cost due diligence and all that. Now let's talk on the deduction point here, Barry. So this is interesting, right? So part of when I hear deduction, I think about depreciation, right? If you buy real estate, one of the best ways to get a deduction on the cash flow, if you will, is to take depreciation from the asset. And that's, to me, one of the top 3 reasons to own investment real estate. Right. Now, if you've owned it for 27 and a half years, let's say multifamily, you have no basis. If you've owned commercial for 39, it's no basis, right? Sure. Or if you've done 1031 exchanges, your old depreciation schedule travels. So the intent is to get a brand new depreciation schedule. The challenge is the 1031. To me, it's the blockbuster way of doing things, right? Because of the old depreciation schedule. The Deferred Sales Trust, though, you can partner with the trust, buy real estate. In fact, we're doing a deal right now out of Alabama. Client sold a $2.6 million business, had no basis, deferred about $600,000 of tax. Now he's building with partnership with the trust 70 units in Tennessee. Ground up development, and the project might cost him somewhere around $5 to 6, $7 million bucks. And then he'll be able to sell it, but he'll get all of that accelerated depreciation to get that deduction, if you will, right? So when you're saying deduction, are you referring to stuff like depreciation?
No, it's actually a deduction. So just like a charitable deduction, So you say, well, if I'm in the 35, 40% tax bracket, that's, think about what that's worth, right? And so the time to do this is when you're in your highest income brackets, right? Because then that deduction counts against that highest tax bracket. And so what we always say is do it before you retired, do it while you have a lot of income coming in, because the benefit can be even bigger. And it's massive, right? So I love what you're saying. I mean, you're brilliant and smart, Brett. You're absolutely killing it with what you're doing. And for those in the real estate, I mean, hands down, what you're talking about is spot on. And it's brilliant. And Kevin should come back to the table to talk about a stock. But at the same time, I mean, we should, what people need to look at is if they're done with that, right, and they want to do, and they're moving towards retirement age, then some of these other things should be considered, like I've been talking about.
Again, yeah. So deduction, great. You can literally just take it off your income, right? Which is phenomenal. Yep. By the way, if you're a real estate professional and if you can do cost seg and you're an active GP on a deal, Trump gave us an amazing break to be able to offset some even W-2 income, which is pretty cool too as a deduction. Just a little side note to that. The other thing is time flow of the cash. So if you can delay the income from something, what would that mean, Barry? In other words, someone has an ultra high net worth, they're taking on all this income. If they can park it in a different vehicle, and perhaps that's to do with the CRT as well, right? If you don't need as much cash flow, you let it all build up over there and then take income later on. Talk to us about the time value of that as it pertains to income tax brackets.
Sure, absolutely. So I think in those scenarios, I think what we do is we wire it for the deduction up front, get a huge big deduction, and you take the smallest amount of cash flow coming out, because you do have to take some cash flow out of that asset, out of that charitable remainder trust, but we dial it in to take very, very little. And so we're going to max up the deduction up front. And I think the other thing that people haven't, and we talked about it and I didn't want people to miss, is the reality that people need to think not only just about estate tax, but double taxation. And what people don't realize is they have spent their working life building up these retirement assets, IRA, 401ks, and then they're going to get that estate tax exclusion brought down. There's been a group that's talked about getting it down to $1 million. I know that's not in the current proposal, but they've talked about going all the way to $1 million for an individual or $2 million as a couple. And you're going to take and put a 401k or IRA balance plus that's a double taxation where people will leave maybe half to 40% as a result to their family through that means. So looking at these strategies are super important and probably only become more and more important, but the time to act is sooner than later for that stuff.
It's right now, right? So if you're listening to this for your parents, right, for any friends, and for yourself, right, you got to know what the rules are. And if you don't know what the rules are, there's a lot of wealth that can just, go out the window, right? And just go out of the family legacy. And, we believe that money is always best kept in our families, our clients, our communities, because we can hold that money accountable to the charitable causes we believe in, right? But when the money goes to the government, guess what? No matter what side you're on, they're going to waste so much of that. I think that's the one thing I think most of us can agree to. So if we can keep this tax the highest thing that is expense probably in your lifetime, and this biggest wealth transfer in the history of the planet, according to the American Bankers Association, the baby boomers, right? We have a chance to help a lot of people. So if you're a business professional, it's not just an opportunity, it's your responsibility to really get this information out and help your clients make great decisions today, okay? So that being said, are you ready for the lightning round?
Lightning round it is. And can I add to that?
Yeah, please.
If you're a business owner, a real estate person, if you are an executive, and you have individual stock holdings, you have individual asset and real estate holdings, the things that we're talking about here, Brett, you cannot pay lip service to. You have to explore them. Like you said, it's your stewardship responsibility to know what's available to you to do this right, because you need it, your family needs it, the social causes you care about deserve it. And certainly Washington doesn't, because they're terrible stewards of our money, your money and our money, right? It's our money. Yes. They think it's theirs, but it's our money, and they're terrible stewards of it.
Amen, Barry. I'm with you. I love it. All right, cool. So with that, are you ready for the lightning round?
I am.
Okay. So,
All right.
yeah, so I was just saying, amen. I love it, brother. It sounds great. And we're on a mission too to spread the message of that. So, first question of the lightning round. Knowing what you know now, Barry, if you go back to your 25-year-old self, what's the one golden nugget you'd make sure to tell yourself to do?
Be curious more often.
Perfect. Great answer. Second, what's the number one book you've recommended or gifted the most in the past year? And by the way, you can also plug your book again. I love that.
Well, of course, every book I run. The first book I wrote was The Secret of Wealth with No Regrets. The most recent one has been with Kevin Harrington, Build Wealth Like a Shark. I love the writer because he's simple. Andy Andrews, The 7 Decisions of Success. Really great book of modern reading. And of course, my dad had me read when I was a kid. Why is it?
Is it Rich Dad Poor Dad? Is it
No, it was
How to Win Friends and Influence People?
That one plus Think and Grow Rich.
Oh, Think and Grow Rich.
Yeah.
Beautiful. Love it. Next question. What's the biggest challenge facing your industry right now?
Finding advisors that'd be honest with you.
Good answer. Next question. What are you most curious about right now?
How to be the best father and husband that I can possibly be. And when we have so much coming at us, I have 2 kids, I've been married 21 years. And just how do I do that? How do I do that well and manage, being a business owner, entrepreneur, and advisor all at the same time?
Excellent. 2 more questions. This one's on the 1031 exchange. I got to ask it. What's the biggest frustration you or client, or family, friend member has had when it comes to the 1031 exchange?
It's not realizing what it means. Because as they do it, they defer it, not realizing the piper is going to get paid down the road, and they deferred it without having an exit strategy.
Right. Or they just defer it and overpay for a property and take on too much debt and don't diversify, right? And then in 2008 crash, when I watched in Sacramento, a lot of people lose half or all of their wealth. And they knew they were overpaying, but they felt trapped by I call it the shotgun wedding, right? You get engaged in 45 days, 180, but now you don't have to do that anymore. You can do a CRT, you can do a deferred sales trust, right? And you can defer all the tax, pay off all your debt, and then diversify in stocks, bonds, mutual funds, businesses, hard money lending, all kinds of different things. Okay. So go to capitalgainstaxsolution.com to learn more about that. Okay. Last question. So Barry, after all the people you've helped, I mean, amazing. You got a book with Kevin. And that's a whole nother podcast we could probably have. After all the success, all the people you're helping, I'm curious, how do you stay centered in your values and how do you stay encouraged to reach for new heights?
Well, centered in my values, it's very important to have the right people around you. And I'm in different groups of Bible studies and stuff, and that helps me spiritually stay grounded. And my wife helps me stay grounded. As far as shooting for the stars with new things, I think that's where coaches come in, mentors and coaches that help you expand what you can do beyond what you even thought was possible.
Amazing answer. And for our listeners who want to get in touch with you, Barry, would you remind them one last time how they can find you?
Absolutely. wealthwithnoregrets.com. They can email me, Barry, Barry, at wealthwithnoregrets.com, and find me that way or call me 678-278-9632.
Barry Spencer, everybody, out of Atlanta, Georgia. Check out his book with Kevin Harrington. And Barry, I want to encourage you to keep using your gifts of leadership and helping people have vision to clarify what they want and where they are now, and to use your gift of thinking strategically to help them map all of this stuff out with tax and finances and legacy, right, with their financial plan. I so appreciate you being on the show, and thank you so much for being here. And I also want to thank our listeners for listening to an episode of the Capital Gains Tax Solutions podcast. As always, we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy, such as the CRT with Barry Spencer or the Deferred Sales Trust with us, is the best way for you to exit your highly appreciated assets. Cryptocurrency, highly appreciated public or private stock, primary homes, investment real estate. Go to capitalgainstaxsolutions.com to learn more about that, or reach out to Barry if he can help you as well. We so appreciate you watching or listening to the show. Please rate, review, subscribe to the show. It sure helps us get the message out of helping people escape feeling trapped by capital gains tax. Hey, thanks everybody. Have a great day.
You have just listened to another information-packed episode of Capital Gains Tax Solutions with Brett Swarts. We hope you enjoyed today's show and found it helpful. Visit capitalgainstaxsolutions.com to access the show notes and to access more resources. Don't forget to leave a review and join us again next time.